I'm Matt Cosin from Ellis & Associates Wealth Management. Thank you for joining us and welcome to our fourth and final episode in our series on capitalizing on opportunities available now. This episode should last about 15 minutes and I will be moderating with William Ellis as our presenter. Please type any questions you have in the chat box during the session. We will address them in the time allotted at the end. The webinar is being recorded and we will send you a link afterwards so you can view anything you miss or to pass it along to someone who might benefit from listening. As always, we will post it on our website where you can view it anytime. You can also view our previous webinar episodes on our website in our content library. Our webinar today has 4 sections. The first is a look at current interest rates in Canada. The second section takes a look at the impact of low interest rates. The third section examines how a rise in interest rates may affect your portfolio. And finally, in the fourth section, William suggests how we can anticipate and prepare for the future and a possible rise in interest rates. William, once again, we see this slide. It's a snapshot of the current environment, and can you take us through it in regards to current interest rates and what is available to investors?
Sure, Matt. Again, this is the estimated market yield slide. And just to give context, the top line indicates what inflation is these days at 1 to 2% a year, very tame. And just below that, you see the investment alternatives that we're focused on today, which is interest rates. Cash and bonds pay a rate of interest as their return. And in both cases right now, they are yielding 1 to 2% a year. And with a 1 to 2% estimated market yield, the current returns that are available to investors from interest rates is extremely low. After taxes and after inflation are taken into consideration, it's a losing proposition.
So now that we've recapped what is available to investors, what is the impact of the current low rate environment?
Well, a lot could be said here about the impact of low rates, and the low rates have created winners and losers.
So who are the winners?
Well, you're winning if you have a big mortgage, and you're paying, say, 2 point something on your mortgage. You're winning if you're a business financing investments in plant and equipment and business expansion, again at record low interest rates. On the other hand, you're losing if you have money in GICs. Think of this, if a bank is lending out mortgage money for 5 years at 2.8%, you know that they're going to pay you less than that on your GIC. So it's a challenging time to be an investor looking to earn income. And this really increases the need for smart investing strategies and tax-efficient investing.
When was the last time we saw interest rates this low?
How about never in our lifetime? The next chart illustrates how current interest rates are unprecedented in the past 50 or 60 years.
And so the chart you mentioned goes all the way back to 1790, but what is the chart actually showing us, William?
Well, there's much we could say about this chart. It's an American plot. It plots long-term interest rates in the United States over the past 200 years and change. Along with the interest rate, the chart also notes significant periods of crisis, such as the American Civil War, the Panic of 1907, the Great Depression, and World War II. And throughout that entire 200-year period, the historical average interest rate is just below 6% at 5.8%. Except for rare occasions, the interest rate has been either above or below that average of 5.8. Now the average of 5.8 you can see there as a straight line across. It plots right across this chart, obviously. If we compare that straight line with the course of actual interest rates over the past 200 years have moved up and down. They've rarely stayed the same year over year. And to get rates similar to what we are experiencing right now, we have to look back to the 1930s and the 1940s to see a period of comparably low interest rates. And if we go just past that into the 1950s, 60s, and 70s, we saw a relentless ratcheting up of interest rates, and after that, almost a mirror image decline in interest rates until today. When you see how low interest rates are today, and you see how interest rates are either moving up or down, you can see why this webinar has been arranged to pose the question, what if interest rates rise?
And this slide's a little tough for some people to imagine, but it's an estimate of how much money you need to invest to earn $25,000 in income from a GIC. William, what does this mean for our clients?
Well, this is where the rubber meets the road, I would say, because it really illustrates how much money you need to earn $25,000 in interest income. Let's just look at 2 points in time. In 1982, on the left there, you'll notice, when you could lock in interest rates of 15%, how much capital did you need to earn $25,000 of interest income in the year? Well, it indicates less than $200,000. If we fast forward to 2011, which is indicated on the right hand of the slide, with interest rates currently of about 2.5% a year in 2011, you needed $1 million of capital to earn $25,000 of interest income. What this means for investors is that if you want to live off your interest income, you better have a lot of money, or you better be prepared to live on a lot less.
And this time we have highlighted interest rates as an item outside our control. William, can you briefly add to this?
Interest rates are one of those things that we have absolutely no control over. It's like the economy, taxes, inflation, and corporate profits. What we can do, and the only thing we can do, is to anticipate and prepare for an increase in interest rates from these levels. Now, the topic of this webinar is, what if interest rates rise? The impact of a rise in interest rates really depends on why interest rates are rising. If interest rates are rising because growth in the economy has been improving and the demand for scarce capital is driven up in price, is it because of an increase in inflation? Are interest rates going up because of something called stagflation we haven't heard of much recently, which is a combination of a stagnant economy and price inflation? Is there a currency crisis that requires the central bank to raise rates to prop up the value of the dollar? So determining why interest rates have risen will explain how businesses will be impacted. On their own, with nothing else changing, higher interest rates are negative for equities. However, if interest rates are higher because business conditions are improving, well, generally the improved business conditions outweigh the drag from higher interest rates.
And now that we have talked about determining why the rise in rates, what kind of impact would this have on a fixed income portfolio, William?
Yeah, so in the last slide we were talking about the impact on businesses and equities. This slide is telling us how a bond portfolio is impacted. While the impact on equities depends on the reason for the increase, with bonds the impact of higher rates on the value of bonds is clearly negative. Higher interest rates mathematically equate to a lower bond value, and the longer the bond maturity, the greater the impact negatively on the value of the bond. This slide illustrates the math. If we look at the line right at the bottom of the slide, that's referring to a Government of Canada bond coming due June 1st, 2041, which is 28 years out. The current yield a couple of weeks ago was 2.6%. The question is, what is the impact of a 1 or a 2% increase in interest rates on the value of this bond? Well, moving from 2.6 to 3.6%, the bond suffers a 16% loss in value. And at 4.6%, a 2% increase in interest rates from current, the loss is 29%. Now, you can hold the bond until maturity in 2041 and continue to earn a rate of return that equates to 2.6% based on the current pricing of the bond. But if interest rates increase 1% and you decide you want to sell the bond, you'll face a capital loss of 16% or a loss of 29% if rates are 2% higher. It deserves mentioning that in addition to interest rate risk, the risk of a decline in the value of your bond holdings if interest rates rise, an investor also faces credit risk, the risk of a default or even a deterioration in the creditworthiness of a bond issuer. The recent credit crisis in Europe reminds us that sovereign governments can run into trouble. And this slide is an alphabetical list of sovereign credit defaults.
I see you only got to the C's.
Yep, that's right. There are a lot more nations that have defaulted, and many more than once, as indicated on this slide. You'll notice, thankfully, that Canada is not on that list. But there were concerns 15 years ago, seems a long time ago, and we're quite smug right now regarding our country's finances. Obviously, there wasn't a credit default. But in the late 90s, there was enough concern that the currency dropped and interest rates were much higher in Canada than the US. So even Canada isn't immune. Our credit is well respected today. If you own a Government of Canada bond, though, coming due in 2041, you have to be concerned about what our credit worthiness is, not only today, but what it will be years into the future.
So how do we help clients anticipate and prepare for a rise in interest rates?
Well, said quite simply, we favor short-term bonds, are cautious against the longer-term bonds, which we think could be subject to a large sell-off, and we're looking at other attractive income alternatives.
Thanks, William. So we will now begin to answer questions from the chat, and the first one I have is, when do you anticipate interest rates rising?
Well, we don't know. No one knows for sure when interest rates will rise. And we know that central banks around the world, the ECB, the Fed, the Bank of England, the Bank of Japan, they've all committed to holding their easing stance until growth targets are hit. Most forecasters that we hear don't see the Fed raising rates in a meaningful way for the next few years. The reason for the central banks doing whatever it takes to keep rates low is that the economy has not yet achieved what we could call escape velocity. They haven't yet transitioned to a self-sustaining recovery without doses of low interest rates. And unemployment is still stubbornly high, but central banks have warned that higher rates will eventually come. We expect that it is still some time off.
And the second question here is, what are some of the income alternatives, and are you taking on more risk?
Well, that's a good question. On the estimated market yield slide that we mentioned, on there is noted the dividend portfolio, which provides a cash dividend yield of 4%. That's a core holding. And as we've said before, you don't get something for nothing. The dividends are not guaranteed. The stock prices aren't guaranteed. You're invested in equities that vary in value day by day. Now, we believe the underlying businesses are more stable than the price traded on the stock market. And the dividends in the businesses we own, although not guaranteed, are stable and growing at a good clip, exceeding inflation. Over time, we expect to be rewarded as owners of these businesses. But Matt, there will be bumps along the way, and there's no guarantees as to the exact outcome.
Thank you. Well, there's no more questions in the chat, so thank you for joining us today. And if you'd like to discuss today's webinar further, please feel free to contact us at 416-969-3190. Thank you, and I will now end today's session.